Time now for the word on Wall Street. Top investors watching your money. Joining me now, UBS Wealth Management Senior Vice President Brenda O'Connor. Juanas, also with me, Ryan Payne. Brenda, let's start with you. So obviously the stock and the bond markets are closed for the holiday for Martin Luther King Jr. But equity futures are trading. It's going to be volatile, obviously. They're going to trade at least till 1 p.m. Eastern time today. Let's take a look at Friday because of these earnings we got. As you can see, the Dow lost 118 points on Friday. The S&P and the NASDAQ were higher. The Wall Street Journal is finding that economists have lowered the probability of a recession within the next year to 39%, but many say it's still going to feel like one. And then you still have a lot of investors expecting the Fed to cut rates, despite those inflation reports that we got last week. 7 Fed officials expected to deliver remarks this week, Brenda. How does this play into your outlook right now? There's a lot of differing pieces of data that we're getting, and frankly, opinions that we're getting.
Absolutely. And Cheryl, look, this elusive soft landing that no one ever thought was going to happen, well, it actually does look like we're headed in that direction. But here's the thing, and you guys alluded to this in your previous segment, consumers don't think that. And that's mainly because you've seen the purchasing power of the American consumer decline by 25% in the last few years under this administration. And so here's the thing I would focus on going forward, irrespective of what happened last week. You know, we are going to see the Fed cut. The market is pricing in 6 cuts starting in March. Personally, we think that is way too optimistic. And if you want to understand why there's the disconnect, to your point, Cheryl, look at last week's inflation number. That headline ticked up to 3.4%. And what that tells me is, well, there's still some work to be done in the next 4 to 5 months.
Well, let me ask you then, if it's not going to be 6, then what's it going to be, Brenda?
So we actually think it's going to be 4 rate cuts starting in May. And I want to bring up a point here. We actually put out our outlook for 2024 back in November. We've revised that even though we're 2 weeks into January here. And a lot of that is because of what happened at the tail end of last year. Listen, the drive was due to inflation and the job market posting good numbers. But let's be honest, the biggest driver here was the Fed giving us this unexpected Christmas gift to the markets. And the markets ran with that aggressively. So we've adjusted our views on rate cuts. We've adjusted our views on the S&P, and we've adjusted our views on the 10-year as well.
All right. Well, obviously, we're going to hear from the Fed at the end of this month. We'll see what the commentary is. And I think it's interesting you're still saying 4, because that means, and Ryan, I'll take this to you, that means that something really bad is happening in the economy.
Well, I think if you get, right, I mean, well, the market's pricing in 6. So if we get 4.
Brenda says 4.
Yeah, that's a little bit less. But I think bottom line is I think the Fed will cut less because the economy is going to be stronger than expected. I think, look, you don't need a weatherman to know which way the wind blows. And what we've seen here this whole year, or this past year, is GDP growth has come in better than expected. We're expecting like 1.5% growth this year. I wouldn't be surprised if it's over 2.5%, because productivity gains have been phenomenal. They were great last year, and I think you're going to see the same this year as margins expand for businesses because they're using AI, they're using automation. So I'm actually pretty optimistic in terms of the fact they won't cut as many times, is because the economy is actually doing well.
Yeah, I mean, well, again, all that's going to play into the earnings reports we get and the forecast as well. And I'm glad you brought up that AI issue. We've got a lot of fourth quarter earnings on deck this week. We're going to get Morgan Stanley and Goldman tomorrow. And then we're going to get some of the regional banks, PNC, Charles Schwab, Citizens Financial Group, M&T. That's through the week, Ryan. And again, this financial reporting season has been messy, to say the least.
It definitely started messy, but JP Morgan did have record profits last year. If you heard about the state of the consumer, it sounded pretty good. I heard Brian Moynihan from Bank of America talking about how he continues to see the consumer spending on services. And I was at a restaurant last night at 6:30, absolutely jam-packed. People are out spending in the economy. And if you look at average deposits at Wells Fargo, they're actually still higher than they were pre-pandemic. So people still have money in their bank account, and wages are going up this year. So I think you're going to see actually a pretty good earnings season this week. I think Morgan Stanley, Schwab specifically. Schwab is like a wealth management firm like my firm. We had a great quarter. I'm assuming that they're going to see the same benefits from markets going up. And Morgan Stanley and Goldman Sachs specifically, if we start seeing mergers and acquisitions pick up this year. IPOs pick up this year, which they should, because interest rates are going down. We know where monetary policy is. That's going to be very, very good for their businesses. And we already saw a preview of that with the big banks last week. M&A activity did pick up. So, there's a lot of tailwinds right now that can really lift a lot of companies that maybe didn't do as well last year. Financials lagged last year at the S&P 500 when everyone was obsessed with tech. And my big message has been you want to broaden out your exposure. My firm, we look at like hundreds of portfolios over the year. People have too much money sitting in cash. We know the Fed's going to cut interest rates, so that rate's going down. I preach this every week. And too much money going into large cap and mega cap names like tech. S&P 500, again, it's 35%, 7 stocks. You've got to broaden your exposure. There's a lot of great places to put your money right now. And most investors aren't putting their money there. And I think that's going to be the big mistake this year that people make.
Interesting. Yeah, Brenda, final word to you.
I agree. I mean, the other area that we're looking to is consumer staples, and here's why. Consumer staples were flat as a sector versus that NASDAQ up 42, 43%. The other reason we like consumer staples right now is that I think it's been penalized too heavily for these GLP-1 drugs. Look, these GLP-1 drugs are significant, but from a multiple perspective, I think that's been unjustified to the sector. So I'd look to consumer staples as well.
All right, yeah, a lot to watch, and definitely this could be the year that we really diversify from tech, but keep that NVIDIA stock. Brenda O'Connor Juanas, thank you for being here. Ryan, of course, you're going to stay with us all morning long.
Thanks, Cheryl.